Now let's look at the head and shoulder pattern. I want you to pay attention to this section of the video because these patterns are a little more complicated than the double top and double bottom patterns. The head and shoulders pattern is a bearish pattern that occurs at the end of an uptrend and at the beginning of a downtrend. Here is a simple illustration of the pattern. We first have an up move till point A. Then, the price makes a pullback to the point B. Subsequently, the price again makes an up move that goes beyond point A. But that move is short-lived and the price falls again. We call this peak as point C. The down move is stopped at point D and the price moves up for the third time. But this time, the price reverses below point C. We call this point as point E. After point E, the price tanks and never comes back up to these price levels. As you can see, the pattern has 3 peaks and 2 valleys. The peak in the middle is the highest and the peaks before and after it are lower. The pattern resembles a human upper body. The peak in the middle is the head while the peaks to the left and right are shoulders respectively. To trade this pattern, we will create a neckline by connecting the valleys, that is, point B and point D. When the price breaks below the neckline, we will enter a sell trade. Here is an example. On this chart we have the GBP-USD pair on a 30-minute time frame. Here, we see that the price makes this up move. It makes a top and pulls back. We call this point as point A. The pullback reaches point B, and the price starts to move up again. This time the price breaks above point A, but it fails to sustain above it. It creates a higher high at point C and reverses. Then it falls down again and creates point D. Finally, the price moves up again for the third time, and this time the price does not reach near the point C. It creates a lower high at point E and it reverses. At this point, we realize that the price might be forming a head and shoulders pattern. We have a head in the middle and 2 shoulders. So, this is an amazing trade opportunity. But we cannot place a trade just yet. We will create a neckline by connecting the valleys of point B and D. When the price breaks this neckline, we shall enter a sell trade. On this candle, the price breaks and closes below the neckline, so we sell here. We will keep our stop loss at the midpoint of the neckline and the head. We can place our targets by calculating the distance between the head and the neckline and adding that below the neckline. And as you can see, this trade played out really well. Here is another example. On this chart we have the Apple stock on a 15-minute time frame. Here, we see that the price made this strong up move up until point A. Then, the price pulls back and creates a swing low at point B. The price then makes a new high at point C, which is above point A. Subsequently, we see the price pull back again up until point D. The last push in price comes after point D. But the up move fails as the price does not break above point C. So, the price creates a lower high at point E. At this point, we realize that price might be forming a head and shoulders pattern. But the pattern is not complete yet. For our entry, we create a line by connecting points B and D. On this example, we see that the neckline is not a horizontal line. It is tilted and more of a trend line. And that is perfectly fine. It is not necessary that the necklines will always be horizontal. They can have an angle as well. On this example, the price breaks below the trend line on this candle. So, we will enter a sell trade on the close of this candle. We can keep our stop loss at the midpoint of D and E. Finally, for targets, we shall calculate the distance between point D and E. We will subtract the distance from the neckline to calculate our targets. And as you can see, the price achieved our targets on this trade. So this was the head and shoulders pattern. Now let's look at the last pattern. That is the inverse head and shoulders pattern. As the name suggests, the inverse head and shoulders pattern is nothing but the mirror image of the head and shoulders pattern. Here is a simple illustration of the inverse head and shoulders pattern. First, we see a strong down move that stretches down to point A. Then, the price makes a pullback up to point B. Subsequently, the price makes another down move that goes beyond point A. We mark this new low as point C. After point C, we see another pullback till point D. Then, finally, we see the price try to make another down move. This time the down move is short-lived as it extends only till point E. After point E, we see the price makes a strong and impulsive up move and never come back. Now let's look at a real-world example. On this chart we can see that the price made this strong down move initially up until point A. Then we see a pullback till point B. After point B, the price again moves low, and it breaks beyond point A to create a lower low at point C. The point C is followed by a pullback up until point D. The price then tries to move down for the third time, but it fails miserably. The down move is short-lived as it reverses upwards after creating point E. At this point, we realize that the price might be creating an inverse head and shoulders pattern. We see a head in the middle and the shoulders on the left and right. So, we will create a neckline by connecting points B and D. Notice how the neckline created here is downward sloped. On this candle, the price breaks above the neckline, and we enter a buy trade here. We will keep our stop loss at the midpoint of D and E. And we will keep our targets by adding the distance between D and E to the neckline. As you can see, the price achieved our targets on this trade.